Thanks, Marty. Hi, everyone. Alfonso here, also go by Alf. It's a little bit easier. I'm an Italian guy who used to run $20 billion for ING. It's a European bank, small presence in the US, but a very large global bank. I quit the bank to start my research business, which now has Citadel, Millennium, Bluecrest, and other large hedge funds as clients. But I'm an investor, so running and opening my macro hedge fund, which starts trading live in January now. So that's my new journey. And I'm here to try and not make you bored listening to consensus macro trades and macro ideas. And the first thing I would like to do for this presentation to you guys is to share you something about the Trump trades. So this is something that Marty discussed. Everybody wants to know how the Trump economy will look like, but I'm an investor and I want to know how the Trump trades are looking like. And this is something that I hope will give you some perspective of where different asset classes are priced by investors, because in macro, you don't make money by being right. You make money by catching consensus off guard. So measuring consensus is the most important thing that a macro investor can do. So let's take a look at it. What I did here is I used 2016 as a reference. Of course, the world is not exactly the same, but the Trump victory of 2016 was as strong, and the sweep of 2024 can be a bit compared to the surprise element of Trump in 2016. So here's what we did. Take a look at the 7 top Trump trades of 2016. Those are the S&P, US banks, the Russell 2000. So that's very clear. The stock market went up and banks and small caps benefited the most. Short 10-year treasuries. So the bond market sold off on the basis that Trump was a push for nominal growth. Bitcoin went up quite a lot in 2016 as well. And then we had dollar Japan and dollar Mexico in the FX for different reasons, being one of the best performing trades after Trump victory. And then what we did is we overlaid the performance using as time zero the day when the Trump sweep odds on Polymarket went above 50%. So when it became clear, basically, to the market that the base case was that the red wave was going to unfold. And now you take a look, and of course you see some similarities, but also some differences here. So first of all, the S&P is up, banks are up, and the Russell 2000 is up. Well, that makes sense, but one thing I would like to notice is that especially banks and the Russell, but also the S&P, they're up less on the same time frame that they were in 2016 after the Trump surprise win. And so the big question here is, why is that? And I think we can immediately move for a second to the second slide in the pack, which is, it's probably there because of valuations. I mean, we have a 0 equity risk premium in the US. I'm going to repeat. You get 0 equity risk premium investing in the S&P 500 today. So high valuations are clearly a reason why the Trump 2.0 trade in the stock market hasn't been so aggressive as in 2016. The way we calculate the equity risk premium is we think like we're an investor, we have a choice, we can park money in cash, we can buy bonds, or we can buy equities. And so what we do is we take the forward earnings yield. So we take the forward PE, basically make the reverse of that. That's the earnings yield, which sits today around 4% in the S&P 500. And then you can subtract third-year treasury yields from it. So a risk-free long-term rate. And what you get, this chart goes back to 1990, is that you are sitting today at the 0 equity risk premium level. And the last time you did that was in 2000. So you're looking at very, very squeezy markets, at credit spreads at the tightest levels over 30 years as well. So the level of complacency that is sitting in markets is quite aggressive. And when you are at nosebleed valuations, it makes it a little bit harder for the Trump 2.0 trades in the stock market to push through. The other interesting thing we have seen is in the bond market. So take a look at the short 10-year trade in 2024, this brown line here. It's basically gone nowhere. It's flat. In 2016, the bond market sold off way, way more aggressively. And so if you try to think, why is that the case? I think there are 2 reasons. The first is that in 2017, we had the most impressive globally concerted growth all over the world that we have ever seen. I mean, even Europe grew 3% real GDP. That's quite something. And the world in 2025 looks a little bit different. And the second reason, I think, is tariffs. So Trump 2.0 is probably a bit different than Trump 1.0 for a couple of reasons. The first is that Trump 1.0 experimented a bit with tariffs, experimented a bit with the political machine in the US. And now Trump 2.0 can figure out a little bit what worked and what didn't. And he's using a very aggressive strategy this time, which is really using tariffs as a bargaining instrument, but pushing very, very hard on the numbers and on the strategy. And so tariffs have this interesting effect where, I mean, if he follows through with this negotiating mechanism, you can have growth in Europe collapsing, and you can have growth in all the trading partners of US collapsing very rapidly for a couple of months, and the reverberations for the US economy are not necessarily positive. And so it's very hard as well to sell off in bond markets as aggressively as in 2016. And then the last thing I would like to notice is Bitcoin over here. And I mean, to Marty's question, I'm going to discuss a bit a macro valuation model that I have for Bitcoin and gold, because you can value Bitcoin and gold from a macro perspective. But first of all, what you see here is that in 2016, Bitcoin went up 50% in 40 trading days. Bitcoin has already gone up 50% this time in 20 trading days. And again, history is not exactly the same. Because this time we're talking about the Bitcoin strategic reserve, which we weren't talking about in 2016. But just to show you that asset classes reacted broadly the same way, with the big difference that the stock market is less enthusiastic, and the reason is zero equity risk premium. And Bitcoin is more enthusiastic, and the reason is that this administration is way, way more friendly. And we're also going to be talking about Bitcoin macro valuations in a second. But before I go there, because I'm in Europe and because I have an Italian accent, I need to talk about Europe for a second. And so this is a chart that shows that consensus thinks that Europe is dying. So what is this that you're looking at? It's a chart that shows the 5-year GDP growth expectations by the economists or the professional forecasters in the ECB survey. It's an astonishing chart. Like in 2001, economists were expecting Europe to grow at 2.5% to 3% a year. Can you imagine that? And that number is halved now. It's 1.3%. And I don't know how you guys would feel in the US if somebody would say the average economist expects the US to grow at 1% over the next 5 years. Something unthinkable, but that's where Europe sits today. And the biggest problem in Europe actually lies in Germany. And if you guys think about it, the German business model is completely broken. It was based on 3 main things. The first was, let's get cheap energy from Russia, not possible anymore. The second was, let's outsource to cheap workers, which are now not cheap anymore, because wage growth in Poland and Eastern Europe is like 10% a year. So sorry, but that's not cheap anymore. And let's sell all our products to China, big buyer. And now also you have a problem because China has domestic demand problems as well. So that part of the business model doesn't work. And then finally, let's not spend anything from a deficit perspective. Let's have this black zero mentality because we don't really need it. And ultimately, when you tighten up on the private sector that much, the results are here for everyone to see. But when it comes to Europe and when it comes to markets, as always, we should ask ourselves, how much is it already priced in? You're not going to make money betting on the demise of Europe if everybody's already betting on the demise of Europe and it's already too much priced in. So to answer this question, what we do is we look at option markets. So bear with me for a second. It's not very complicated. So what we do is we look at option markets, and specifically we look in this case at what the option investors are buying and how much are they willing to spend to hedge themselves against these 4 scenarios in Europe in a year from now. So imagine you're in December 2025. Imagine these are your ECB deposit rate bets. And then these are the probabilities that are today baked in the option market. So first interesting probability, higher for longer, so that the ECB is going to keep rates at around 3.5% for the next year, 0%. There is nobody in Europe that believes or prices anymore in option markets that the ECB will keep rates at 3% or above. The other part of this distribution, which is interesting, is the recession one. I mean, there is now a 45% probability that the ECB will cut rates to 1.5% or below, even to negative interest rates. That's quite impressive. There has been a big, big bid in this European tail risk scenario over the last week, and it's now become almost a base case that Europe will effectively fall into a recession over the next 12 months. So that's how much is priced in. Yes, the business model is broken. Yes, there are good reasons to think that Europe is not going to fare well, but always ask yourself, is actually everything we're talking about already priced in? You want to hear something that is not fully priced in? This is not fully priced in. The US next year has to refinance $7 trillion of maturing debt. So how the heck is that possible? Well, if you ask Janet Yellen, then she will tell you how. She basically issued T-bills like there's no tomorrow for the last 1.5 years. Her strategy was not to spook investors by issuing large amounts of third-year debt to finance the large deficits that Biden was imposing. So she mostly issued T-bills. And the problem is that T-bills, well, they mature very short, right? So they're all coming up to maturity in 2025, and the US has to refinance $7 trillion next year. So now if you think about it, what's the incentive scheme from the Trump administration is probably to have lower rates, guys, because otherwise the interest bill for the United States is going to become even larger than what it already is. It's $1 trillion a year. And I think there's going to be pressure on Powell to cut interest rates. And now if you want to put all together, if you are using tariffs as a bargaining mechanism and you don't really care about a slowdown in the economy in the first year of your presidency, because at the end of the day, everybody remembers the end of the show, not the beginning of the show, then probably you can think that Trump can be a bit more aggressive. And as Marty says, probably not care too much about financial markets and the economy in the first year, and try to achieve something on foreign policy and also on, well, the reduction of federal employees, to put it in a mild way, the Musk and Vivek program. Basically, it's something to think about. The US has to refinance quite a lot next year. It's probably good to do that at lower rates rather than at higher rates. And then finally, I want to bring you into Bitcoin and gold, also because I know by experience that if I talk for more than 15 minutes, people fall asleep. So let's try to keep it shorter than that and finish on a high. So look, I often get questions from my hedge fund clients and investors. What is a fair price for gold? What is a fair price for Bitcoin? So I figured out that maybe I can try to build up a macro model for that. So try to bear with me. What you see on the left side here is the 5 largest economies in the world, and it's me trying to measure how much fiat money sits in these economies. So this is China, the US, Europe, UK, and Japan. Okay. Now, it's not a surprise for you to see that the blue line goes up over time, right? I mean, we are in a world where we can print new fiat money pretty freely, right? This is a fiat system. It's a fully elastic credit system. And now you see the gold market cap on the right-hand side of this chart. And you also understand there is a clear correlation between the two. The more fiat money you print, the more the gold market cap goes up, because gold is nothing else than a competitor for fiat money. It's a coexisting competitor for fiat money that doesn't bear coupons, but also can't be printed out of nowhere. So as a competitor, it tends to go up together with the stock of fiat money. On the right, what you see is the valuation model, which is nothing else than the gold market capitalization in percentage of the stock of fiat money. Well, the first observation I have is that it's a very stable number, around 20%. So gold is often valued in terms of market capitalization at about 20% of the stock of fiat money in the world. Okay? Now you see what happens historically. Every time we try to go to 15%, it's a great time to buy gold. We're undervaluing gold. Every time we surpass 25%, and people are getting a little bit too excited maybe about gold, like it was in 2011, if you remember. QE was going to cause inflation, gold was an edge, so on and so forth. People got overexcited. Where are we today? Here, 25% again. So are people overexcited about gold? Yes, they are. Is there a good reason why they should? Yes, I would say, because the confluence of geopolitical tensions, fiscal deficits around the world, and central banks accumulating gold in their FX buffer is actually quite interesting. But people are overexcited about gold today. So then the question is, are they overexcited about Bitcoin as well? And can we apply the same model for Bitcoin? Okay, now you look at these charts and you say, let's do the same. Let's take the Bitcoin market cap and let's compare it with fiat money around the world. Also here, very clear correlation. and look at this chart, obviously we are breaking out. I mean, Bitcoin is going up much faster than the stock of fiat money today. But here there is something that I would like you to think about. And coming back to the strategic Bitcoin reserve, take a look at the axis here. Bitcoin market cap today represents less than 3% of the stock of fiat money, 3%. For gold, remember the average valuation is around 20%. So today Bitcoin is, more or less as a market cap around 1/8, 1/9 of the gold market cap. So you should always ask yourself here, I guess, what is the ratio between the Bitcoin market cap and the gold market cap that does make sense over time? Does it make sense for you that Bitcoin should represent about 1/8 or 1/9 of the role that gold has as a substitute or a coexisting alternative to fiat money? Well, all bets are off if you think that this ratio shouldn't be 1/8 or 1/9, but it should be something like 1/5 or 1/4 over time. Then clearly the range here that we're looking, the scale between 0 and 3% can be wrong over the medium term. And now, how do you break up from 2 to 3% all the way up to 5 or 10%? It clearly needs some institutional adoption. And so far, we haven't had too much, I would say. It remains an asset that regulators are not willing to pass in their liquidity buffer. I used to work for a bank. Gold is not a high quality liquid asset. You cannot own gold as a bank treasury in your liquidity buffer. And at the moment, you can't really own Bitcoin either, but it's more about institutional adoption here, which we haven't seen in a large scale yet. Were we to see that, Bitcoin Strategic Reserve is a huge way to make that happen, then all the bets are off.
Alfonso, can you describe, so we had Jim Scheinberg speak back in 2016 when Bitcoin was going like to 15,000. And he said that if it went to 200,000, the impact would send a shockwave around the world economic markets, especially with regards to currency exchange. Do you have any thoughts on that?
Yeah, look, I mean, this is a bit like using gold, adopting gold as an institutional asset class. So, as I said, regulators are not happy to do that, Marty, so they don't allow banks even today to have gold in their liquidity buffer. But what happened is that central banks actually adopted gold in their FX reserves buffer. So central banks around the world don't need any domestic regulator to tell them what to do and what they can't do. So this is a space to watch very, very clearly. If you start to see relatively large foreign central banks start to have some Bitcoin into their FX reserves, then I would say this can be quite interesting. Before that, I think it's going to be hard. The US can spare at the effort. The Bitcoin Strategic Reserve can be a huge way to boost institutional adoption for Bitcoin. And it doesn't matter really the price. It's more about herd behavior. If you think of markets, what's going to happen is that if a relatively large institution adopts Bitcoin into their balance sheet as a strategic allocation, then probably others are going to follow as well.
So there's 8 or 10 countries out there right now who only use the dollar, or they're pinned or pegged to the dollar. I guess like Panama, Ecuador, etc. And then there's one which I think is El Salvador, which is pegged to Bitcoin. Do you anticipate maybe other countries would move in that direction?
I would say that it's definitely, if I were them, rather than being only stuck in the euro-dollar system, where effectively you are fully dependent on dollar, you have to indebt yourself in dollar and you can't print it. You are giving away the control basically of your dollar liabilities and what happens to them to the United States. If I were them, I would consider that a small portion of my portfolio can be in Bitcoin. Now, Panama is not going to move the needle. Ecuador is not going to move the needle. You need some larger foreign central bank to start doing that. And if they do, then it really changes.
So Trump stated that any of these BRICS countries that tries to move towards a separate currency from the euro dollar or the dollar would pay 100% in tariff.
Yeah.
Is that a paper tiger, or is that something that will, keep the BRICS away from doing that, or what are your thoughts?
Well, I think that's a move actually to make sure that the US spearheads the institutional adoption of Bitcoin before somebody else does it to a large extent. Look, if I am Russia or China or India, I do have a large amount of dollar debt on my balance sheet, okay? So even if I wanted to get away of the dollar system, I would have a problem. Because if I get away of the dollar system, I don't have dollar inflows coming in anymore. Where do I get my hands on new dollars to pay my dollar debt? I can't really. So then the only bet that is really convex to try and protect me against that scenario is to move a little bit of my balance sheet into Bitcoin. And I think Trump wants to avoid that. He just wants to make sure that if there is one large country that spearheads the adoption of Bitcoin, then it's US rather than anyone else.
So I think that there's $11 trillion of euro dollar debt.
Yeah, there are $12 trillion, correct, Marty, of Eurodollar debt. So what is that? It's basically dollar denominated debt, which has been issued by banks, corporates, or banks and corporates mostly, or governments that are not the US. So this is like China issuing dollar debt, Brazilian corporates issuing dollar debt. And you can see the problem there. I mean, to refinance this and to service this dollar debt, what you need is dollar income. So how can you get out of the dollar? I mean, the only thing you have, the only option you have is to default on your dollar debt. But who's going to want to make business with a country that decides to default on payments?
Do tariffs, do tariffs make the dollar more expensive?
Yes, they do. So the effect there is that Trump is then able to generate quite some spread misery around the world because the US doesn't benefit from tariffs. I want to make sure that that is clear. No one benefits from tariffs from a real growth perspective because global trade actually declines. And when global trade declines, everybody suffers. The question is who suffers the most? And tariffs tend to be more heavy on countries that have the US as the big trading partner. So stuff like Europe and China and Mexico and Canada, than they are on the US itself. But it's a negative sum game for everybody.
And isn't Trump's policy directive to have a weaker dollar?
No, I don't think so. Actually, looking at Besant as well, statements are that they don't want to see a weak dollar. What they really want, in my opinion, Marty, is lower interest rates. That's what they're trying to achieve here. I mean, look at this chart. This is astonishing. $7 trillion to refinance next year. If you were the administration trying to reduce deficits, well, let me break it to you. The US printed 7% deficits last year. Half of it was interest payments on debt. So if you have $7 trillion to refinance next year and you want to lower the deficit, then I can suggest maybe that you want to refinance at lower interest rates.
Yeah, interesting. Do we have any questions from the audience? Any thoughts? Yep, Andy?
In terms of the value of Bitcoin versus gold, each has scarcity value. You can't just, 85% of the gold in the world is held as a stored value. It's not on your ring, it's not anywhere else. It's in a basement somewhere. You can get more, but it's very expensive. It's not easy, it's not fast. Satoshi algorithms in Bitcoin limit the amount of Bitcoin that you can create. So you have scarcity value, which is why it's the only cryptocurrency of its kind. So how does he look at scarcity value in terms of relative value of these different assets?
How do you juxtapose scarcity value of Bitcoin versus gold?
Yeah, look, this is a very valid question. And the answer is that the scarcity of gold, as you can see in this chart, is quite well documented. Gold market cap is pretty stable versus fiat money. And what it means is that the stock of fiat money goes up because that's not scarce. We can just print it whenever we want in our system. But what that's going to do is just going to send up the gold market capitalization higher. So therefore, the ratio between the two remains relatively stable around 20%. So that's a well-documented behavior. And this valuation model just tells you when you are a little bit overexcited or underexcited versus that 20% target. But for Bitcoin, the story is really different. I mean, why would 1% be the medium range here over the long run? Why not 3, 5, 7, or 10%? So what we're really discussing here is, given that Bitcoin is scarce, like gold is, what is the y-axis level that we think Bitcoin should be at as a coexisting alternative to fiat money? In my opinion, 1 to 3% is a relatively low level for this y-axis. So you're just comparing Bitcoin and gold, and you're saying basically what is the role that Bitcoin should play vis-a-vis gold in terms of market capitalization? Should it be 1/10? Should it be 1/8? Should it be 1/7? So what is the ratio? And frankly, at the moment we are at 1/8, but I don't see any reason why over time in a digital world, Bitcoin shouldn't take a larger role in the system. And so assuming that fiat money keeps going up over time, and it will go up, the nature of our fiat system is to create new credit, either from a government or from a private credit perspective. And as fiat money goes up, then Bitcoin and gold market capitalization will both go up, but Bitcoin has a y-axis which is much smaller than Bitcoin on my valuation chart, than gold on my valuation chart. So if I really have to choose for a monetary debasement hedge with convexity, well, nowadays it's clearly Bitcoin rather than gold.
Got it. Russell?
So for the major economies to adopt a strategic fund for Bitcoin, is there any issue with crypto security, more crypto terrorism we're seeing from the country? Does Bitcoin have to go to another level of security? Is that an issue before we see this type of announcements?
There's questions around the security in Bitcoin versus adoption, because I think there's been all kinds of thefts recently, $50 to $100 million of Bitcoin out of people's Bitcoin wallets recently off their cell phones. So, and other types of Bitcoin theft. Any thoughts on that?
I've learned in my previous business, but also in today's business, running money, that if you don't know something, you go back, you study it, and then you come back with an answer. So my answer is, I don't know. I'm going to look into it.
Great. Other questions on the economic outlook? What about real values, like valuations in the private market? Any thoughts on that?
That's a very interesting topic. Yeah, so there's been this promise for a while that if you do private credit or private equity, you get equity-like returns, or probably higher, with no vol. Well, sorry to break it to you, that's not how it works. You're simply not marking the assets. So this is not a new take, it's just how the asset class works. Of course, for the liquidity premium, you also get rewarded. Look, one statistic that I can tell you, Marty, that is interesting. I'm launching a hedge fund, so I'm very much into fees and aligning with incentives with investors. If you look at the average management fee that is charged by a private equity fund today, you are at the lowest level in the last 10 to 20 years. So private equity funds are charging the lowest amount of management fees. That tells me that there is a lot of competition. That tells me that the amount of private equity funds and probably illiquids out there is very large. So if I'm a family office that I have to pick alternatives, especially liquid alternatives, picking the average private equity or private credit firm is not going to cut it. You really have to be very smart in selecting who are the top percentile and quartile managers out there.
Right. I don't think there's any doubt that being, just from having been in this business for a long time, top quartile and top decile probably matters more than ever before. So, Goodwin, you had a question?
Yeah, it's sort of switching. The CEO of Intel resigned this morning, this guy, Pat Gelsinger. So I guess I had two questions. One, what do you expect to happen with Intel, particularly because they have all these CHIP Act dollars that Biden is trying to give them and Trump doesn't want to give them, and the semiconductor ecosystem in general? Where do you see Intel
Did
going?
you hear that? The CEO of Intel resigned. What do you expect to happen with Intel with all the dollars they're getting from Biden and just semiconductor outlook in general?
On Intel, I don't know. On semiconductors, semiconductors are a cyclical business. So we are in clearly an AI CapEx boom that dwarfs the cyclicality of semiconductors. But if you go back and you plot semiconductors, valuations of semiconductors prices versus something like global trade growth, you will find a very tight correlations. So semiconductors are a cyclical business. The CapEx in AI is huge and it's dwarfing the cyclicality. But if Trump comes in with tariffs and he tries to slow a little bit global trade growth, then I'm afraid that semis can be caught in the crosshair. That's a bit of the warning I have on semis. And on Intel, not my cup of tea, sorry.
You know, it's interesting. I think when you know, put side by side the US and Europe and China, and you see directionally where they're going with regards to technology, you know, you might favor the US and China over Europe because it seems, you know, maybe Europe's going in the wrong direction with respect to all this energy that's needed for this AI development, right?
Yes, definitely. Let me tell you a little bit of a story on Europe and tech and innovation. There is a friend of mine who has gotten a Series A seed in Germany for his startup. And he told me that he went to the notary and the notary read the entire Series A deal in front of them. I think he posted it on social as well and it went pretty viral. 12 hours of a notary reading word by word a Series A deal to all participants. That's the innovation that we're going after in Europe. Unfortunately, that's not going to change. It's the DNA of policymakers. We're still talking about black zeros and primary surpluses rather than deficits and killing the private sector. We have an energy problem. I mean, all these problems are at display, but as always, please try to figure out how much of that is already priced in, because you can be right on the macro, but if it's already priced in, you're not going to make money out of that.
Yeah, we've seen a lot of them. So, you know, I just think it's very interesting right now in terms of where the world is at with innovation. So, and we're going to have somebody talking about innovation. By the way, I do want to mention that we're going to have, I don't know if you guys know Open Secrets. They have all of the political donation database, and they're going to be giving a speech today about who won the election in terms of political contributors. I think they're speaking at 3 o'clock. So as you know, a lot of people in Silicon Valley bet one way, others bet the other way. They're going to tell who, obviously the crypto guys gave tons of money to this election and won big. So, so Alfonso, I mean, I've known you for many years. I know that you're raising this fund, and I was hoping that you could give us some kind of a background on the fund and what you're trying to accomplish and why now.
Yep. I'm launching Palinuro Capital. As a proper Italian, and you need to have a very Italian name. So why not Palinuro, my preferred seaside place in the south of Italy? It's a macro hedge fund. Why now? Oh, there are so many macro dislocation opportunities out there. So look, let me show you one chart on bond stock correlation for a second, because I think that's the biggest pitch that I can give here. So this chart shows the stock bond correlation versus the level of core inflation. So most portfolios have stocks or anything else with a beta to equity, like private equity, etc. And then they have bonds as a hedge. Well, I'm sorry to break it to you that historically, if core inflation is anywhere above 3%, the correlation between stocks and bonds is not negative, like in the green area. It's actually positive. And look at history. This is like 100 years of history. Actually, the correlation is more positive, more often positive than negative. So if I am a family office or another institutional allocator, I would really think very hard about how diversified my book is. And if I have fixed income as a diversifier alone, that's probably not going to cut it in the world that is coming. So macro hedge funds are there to try and benefit from macro dislocations, changes in economic trends, and trying to anticipate consensus. That's exactly what we do. We have raised the fund with no seeder, no anchor, haven't sold any revenue share, any equity. We own the fund 100%. We have raised mostly from family offices. We're starting trading in January. The fund is about 70 million big. It's not huge, but it's large enough to allow us to be nimble and invest also in niche macro trends. And look, our motto is embracing uncertainty, because it's not about being right all the time, as I said. It's about measuring consensus and try to catch it off guard. And the fund is called Palinuro Capital. The website is in there, palinurocapital.com. I will be wrong 50% of the times. That's what I can promise you. I will not be right every time. That's not a business of a macro fund. I don't sell volatility. I don't sell options. I'm not going to try and collect pennies in front of a steamroller. We do something very different, which is try to chase or to identify macro trends that are underestimated and be there and capturing right tails for you and provide diversification. That's the pitch.
So you said, it says here that you're leading macro strategy firm as well. That's the Macro Compass, right? So So you have some sub-advisory relationships as well, I guess?
Yes, yes.
Great.
We have Citadel, Bluecrest, Millennium, and a bunch of other hedge funds that are clients of the research. Of course, the research has nothing to do with the hedge fund. In the research, I'm not going to tell people what I run in the hedge fund as positions. The research is there to share views on macro. And, some of these hedge funds really like reading my stuff. If people want to read that, I'm very happy to talk about that too. But most of the focus is to run the macro hedge fund next year.
And are you structured as like a master feeder fund, or you're a Luxembourg fund, or how does it work?
Good old Cayman offshore master feeder. So very standard. We are UK FCA regulated. So try to get a solid regulator behind. Oh, Goldman Sachs has decided to take a bet on us and be our prime broker. Normally, if you have a fund below 100 million, these big banks won't even look at you. But for us, they're trying to take a bet on us. They vetted us, and very happy to be with Goldman as a prime broker.
I would say 70 to 80 million is a good starting point for a fund these days. I know Chip Perkins is the master. What do you think?
Pretty good. I just think 100 is kind of the number.
100 is a good number. Yep, yep. Is 100 institutional, or is it 500 these days?
Institutional. A lot more than that.
150.
But he's right, Goldman Prime Brokerage got rid of all the AUM way over 100.
Wow.
Got rid of all their clients, except everybody small.
So the hedge fund guys here say that you're doing a good job.
Oh, well, thank you very much. I can only tell you I've been preparing this for 11 months now. If somebody wants to open a hedge fund in the crowd, don't do it. Don't do it. A huge amount of work, but thanks for the nice words. The thing that has worked the best, in case you're selecting managers, you don't need to invest in me. Don't worry. I'm not here for the pitch. But in case you're selecting managers in general, something that has worked with me a lot with family offices is just being very transparent. I mean, everybody promises the moon. I don't, and it seems to work.
You need to come to New York and talk to our group in New York, because I think that you'll get great attention.
I'm very happy to do that, as long as somebody please bring me to have pizza, because everybody says I should try New York pizza. I've never done it, so why not?
Yeah, I was in Naples, Italy, and I was told it was the best pizza in the world, but maybe it
You're
depends.
making friends. You're making friends now, Marty. I'm from Naples. Thanks.
Fantastic, great. Anything else you want to tell us about the fund or about macro, or things that we should be considering?
I think that something that people don't often realize with macro is that the opportunities are not only in the US and in Europe. So we've been looking at stuff like New Zealand and Sweden. The gist of it is pretty simple. Even Canada, if you want to have a closer reference to you guys, all the central banks have mimicked the Fed. They've raised interest rates to very high levels. But guys, not all the economies are equipped to handle high interest rates like the US is. I mean, Canada has floating rate mortgages, and the private sector is already feeling the pinch of higher interest rates. And so try to look at funds that also look at these niche markets. And one of the good things of being below 100 or 200 million is that, you don't leave a footprint when you try to engage in these smaller markets. And I think that can be an advantage.
Fantastic, great. Well, listen, Alfonso, great job. We're always interested to hear about you. Maybe you can come to New York for our February event at the end of February. But fantastic, and good to hear all this information about the outlook for 2025. So thanks so much.
Thank you, guys. It's been a pleasure.